Now, at the beginning of every show, I like to do a little summary for what I saw happening in the stock market. So, Monday through Thursday, I do a short video on what happened that particular day. And today, I just kind of want to capstone all that together for those people that just really want to watch it once a week. So let's start off with our chart that we look at pretty frequently here. This is going back to 2018. And you can kind of see, what's been going on. Overall, market's pretty good, but lots of drops in there. We had a 20% drop in 2018, a 35% drop in 2020 with the pandemic, 28% drop in 2022 with the higher inflation. But here we are, still going. We've had a couple of, off weeks, definitely.
Yeah, this week's been pretty volatile, even
Yeah.
though the chart looks very smooth, and it's kind of similar place to where we started the week.
Yeah, I know. It's luckily today is a good day. Otherwise, that wouldn't be true. But it is kind of fascinating that the data that's out there going back to 1928. The first half of July is the best half,
Hmm.
and the reason is because there's all these big funds that are rebalancing and placing money into the market on a quarterly basis and a semi-annual basis. So you get both at the very beginning of July. But the data also shows that the market starts to soften on the 17th, which is
Hmm.
exactly the day that this thing started to soften. Our peak all-time high is on the 16th of July. So there is a seasonality here, and it makes some sense. This massive amount of money comes in, and all of a sudden it's in, and you're going to get kind of this, falling point because there's not enough money to kind of keep it up there, and it's the summer. Uh, Generally speaking, between now and end of October, there are a couple of periods in there that aren't too bad, but it's not the strong part of the year.
Hmm.
November is actually the biggest month of the year, yeah, altogether. And of course, during an election, I've, in my experience with all the elections, November has been very good. Once the election is over, market kind of takes off, no matter who wins.
Hmm.
And so, we have these things going on. Now, of course, I'll put my little line in here. If we're looking at primary direction, just looking at the lows, and we don't want to set a new lower low. In this case, that line is at 49.67, right? We are almost exactly 500 points above that right now, which is, roughly 10%. We could get down to that line during this weakness, as we go through the rest of August. September is the worst month of the year. I think it's the only one back to 1928 that has a negative average rate of return on the
Yeah.
S&P 500, or so that's coming at us. We've got, just be prepared. The pieces that are really going to be driving this market, in my opinion, are, the seasonality, the fact that there's an election in November, so some people might be holding back and just waiting to see what's going to happen before they, get move in once they kind of know where things are. On the other hand, you have the Federal Reserve, right, that is sitting there looking like they might be cutting rates in September. So it's the worst month of the year. Could be offset by a rate cut.
Yeah, they're meeting next week, I believe, on the 31st
Yeah, that's
is their
right.
next meeting. And then right now on the watch tool, it's saying that it's 100% for
Yeah,
the cut
100%.
in
Wow.
the in September now.
Yeah, so that's the expectation for next week is no cut. It's almost 100% no cut, actually. But there may be a setup. That's what
Hmm.
they're expecting. So, some conversations about the rate cut that would happen in September, and we're hearing better and better things from the Federal Reserve in their interviews across the board, specifically because these inflation numbers are coming out better. And I'll show you a couple of those as we go here, as far as that goes. So, uh, all right, so here's the kind of primary trends, breadth indicators, those types of things. No change from last time. We're still in a, primary downtrend, at least on an hourly basis, really
Hmm.
from the, 16th of July. We're still, we're vacillating, but overall been moving down, on that basis. But daily, weekly, and monthly, we're still in a primary uptrend. And then amongst the different pieces here, the Vanguard Total Stock Market Index, the S&P 500, the Dow Jones, we're still all green there. Some of them are getting closer to turning into a different, primary
I think
direction.
stocks is
Yeah,
starting to
stocks
trend.
is that's got a little ways to go, because it just had such a big run up
Hmm.
from that last low. It can fall quite a while before it gets
Hmm.
there, um, and so sometimes that's what happens, right? It just gets too far ahead of itself, and it's got to come back down. It's not a straight line, but if it starts to come back down to a lower low and then keeps going, okay, then the direction has changed and there's a whole sentiment change. I don't see the market going in a primary direction down personally because there's so many pieces that are driving this on a momentum basis. The artificial intelligence. Next week we get what Meta, Amazon, Apple, Microsoft, all reporting. That's often been a catalyst week, not always like a huge upturn, but might stop a downturn. At least for a while. So, we'll see how that goes. Uh, this week, of course, I think one of the biggest catalysts was the Tesla and Google earnings on Tuesday evening.
Hmm.
The market was down over 2% on Wednesday. First time we've had a 2% down day in like 356 trading days. So there's like 252 trading days in a year. So it's roughly a year and a half. We haven't
Yeah,
had a
it's a long
2%
time.
down. Yeah. It's actually the longest we've had number of trading days in a row since before the 2008 downturn. And so, it was kind of a big deal. Tesla missed earnings by 40%, quarter over quarter from last year. The quarter before that, they missed by 55%. And so their stock got hit at 12% drop that day. Google came out, I thought, with decent earnings.
Hmm.
And I thought that was actually pretty good, but they did talk about higher expenses. They're going to be investing more in their artificial intelligence, unit essentially. And some of their guidance was a little bit weaker than they might have wanted. And so Google is down 5%. And so if the tech stocks are driving everything,
Hmm.
and they're starting to have these reports that aren't received as well, and they're kind of priced for perfection. So
Yeah.
they do need to keep doing well in order to stay up. And so what we're seeing is some rotation. So let's talk about that because I think this is very fascinating. So this is the S&P 500, which is the green line, versus the small cap index. In this case, we're going to use the iShares, Russell 2000 ETF,
Hmm.
ticker symbols IWM. This is the last 5 years. So green is the S&P 500. It's up 83%, and the orange is the small cap, ETF, which is up 52%. Okay, so obviously the larger cap components of the S&P 500 were the place to be,
Yep.
right? But in the last month, we've seen a pretty big shift. And let's talk about this just for a minute. So the S&P 500 is basically zero in the last month, right? If you look at that green line. And the Russell 2000, ETF here is up 12%.
Yeah, that's
Okay.
a big difference over,
That's a
especially with a month.
it's a huge difference. Now, one thing I will caution everybody about here, I don't know that we have a full trend here because the initial portion of this motion comes off of record short interest
Hmm.
on the Russell 2000 index. And so on Thursday, a couple weeks ago, we had a really good CPI report that came out, and boom, the market started to move for the Russell 2000. And matter of fact, that particular day, the Nasdaq was down 2%. Russell 2000 was up 3.5%. Right, so that's a really big difference. Because what's happening is if you're shorting, you want it to go down. If inflation's going down and it looks like there's a 100% chance of a rate cut, that's a good thing for small caps.
Yeah, small caps tend to borrow a lot of money to
Yep.
grow, and so having cheaper interest is always good for them.
Yeah, they're more economically sensitive just because of the size, right? They don't have 200 billion in cash or some crazy number like some of these big companies do. And oftentimes, one of the reasons you'll see these big companies doing well is because they're really kind of a safe haven. If you're not sure about what's going to happen, or if inflation's coming back, or they're going to cut rates, then maybe you buy that Microsofts and Apples of the world, Nvidias, because they generate cash. Versus, hey, if things look more certain, you might move down the spectrum of market capitalization, and that's when you start to see small caps go. Now, that's a great thing to see breadth and motion. However, if you look after that first surge, we've gone sideways for a while here. We need
Yeah,
to break out of that to see that next motion because unfortunately in the small cap arena, we've seen a lot of false moves. And where it just hasn't gone anywhere. Matter of fact, if you look back at the 5 year chart, you can look at that orange line. It really hasn't gone anywhere since 2021, right? Still kind of at the same spot. It's looking like it wants to break out, but let's see. But I think it's an important component to watch. Another thing that kind of shows the broadening breadth of the market is the S&P 500 is weighted by market capitalization.
hmm,
So like the top 7 stocks make up some 25 to 40%. I've forgotten the number
I think
of
it's
the
around 40 right now.
yeah of the motion of the S&P 500. So 500 stocks, and 7 of them are making the motions. So the equal weight S&P 500, and this is a Invesco ETF, ticker symbols RSP. Instead of weighting the portfolio, or in this case the index, based on the size of the company, they just give every company equal amount. What is that, 2.5% or something like that?
0.2%.
0.2%, sorry, for each one. And so you can tell they're not too far off, generally over the last 5 years. Still the S&P 500 is up 83% in that time frame, and the equal weight is up 69%.
Yeah, you can kind of see in this last run up, it's
Yeah.
where they kind of diverged a little bit.
Yeah, that low point, that strike that's right above my head there, that was October 27th. And small caps, I mean, in this case, we'd probably be looking at more of the smaller large caps and the mid caps that are part of the S&P 500 didn't do quite as well. And actually, since April, that motion, that's that second dip up there, the last bigger dip, we've really separated. However, if we look at the last month, again, differential S&P 500 at 0 basically, and the equal weight is at 3.7%. So what this is showing is that there's some motion going out into the market. This is a really good sign. Now, I think, and we're guilty of this too. In order to overperform the market with our targets, we've been in those larger cap stocks because that's where the money has been going.
Mm-hmm.
And this week we've been motioning out of those some. We got out of the semiconductor index and started to buy more small caps into targets. In our core positions, we're starting to use more of the total stock market stuff instead of the S&P 500. Again, giving us more exposure across the board to different types of stocks, different size stocks. And that's what you want to be doing right now. You want to be working on the breadth, in my opinion, in case this is something real. And I think it might be, because I think, again, the kickoff for this was predominantly a low CPI report. And so the market is starting to feel more comfortable with the fact that, inflation might be going back down to 2% and the Fed might be actually lowering rates. And that takes away some of the economic uncertainty.
Yeah, it's kind of starting to be a risk-on event.
Yes, exactly right. People are willing to buy smaller companies that have theoretically more risk. They don't have the same balance sheet as an Apple or Microsoft and such too. So I think it's very, very good, because this is what would happen in a normal bull market at about this point. Normal bull markets are 3 to 5 years long. We're a year and 3/4 into this. You should start to see breadth motion and start to see, the things spread out. Now, again, if your portfolio is super narrow and you're still in those kind of mainly 7 stocks, it's probably time to start looking at, breaking that out a bit. And that's what we've been doing and we'll continue to do. Our universe that we work with these ETFs kind of automatically, we see stuff move up by itself and the other things move down. It's a giant competition to get in the portfolio. And so it's sort of an automated process for us. But I'm telling you, that's what's happening. We're starting to see, this small cap and these other types of areas, because the Dow is at an all-time high. It continues to do well. It's more of a value-ish index, at least somewhat so. There's only 30 stocks, but so that isn't true with the Nasdaq, which is coming down off of its highs, or the Nasdaq 100 for that matter, which is the more concentrated version. So today's report was PCE. This has been an important report for a long time. We've been talking about this for a long time. So if you've been watching our show, you probably know that PCE stands for Personal Consumption Expenditure Price Index, and this is the favored measure that the Federal Reserve looks at. And there's top line, which includes everything, and then there's core, where they take out food and energy. And core PCE, which is what I have here for the last 3 years, is what the Fed is looking at when they're trying to get it down to 2%.
Yeah.
Right? It's not CPI. It's not the headline PCE for that matter. It's not the wholesale inflation. It's this. So this unfortunately comes out really late. Just came out today for, last month. Here we are, the end of July. We're now looking at June numbers. But so today it came out flat versus last month, right? It was 2.62. It was adjusted.
Yeah, it was
upward.
adjusted up.
Yeah,
so
slightly.
If you're looking at May's data, it originally was 2.57%.
Yeah, 2.57 was adjusted up 2.62. And today's data for last month, and this is year over year, looking at the same month for last year, 2.63%. So I would rather have seen that kind of continue down, maybe get into 2.4s or whatever, what have you. But Jay Powell made a comment that keeps running through my brain, which is we are not going to wait until it's at 2% to reduce rates because then it could be too late and we could end up in a scenario where we have a deflationary event. So, and that's why the market's betting on, on this September cut. I don't see any reason other than some really wild data point that comes through somehow where the Fed doesn't do at least some rate cut in September.
Yeah, it's starting to price in 3/4 on the Fed watch
Yeah,
a
that's
little bit.
amazing actually, because that, always assuming a quarter point cut. Now there's been a little talk about a half, a little bit of talk about 3/4. Things would have to slow down quite a bit to get
Hmm.
there. I don't see that either, but then that's a small percentage possibility. This is more of a long-term chart. It's kind of interesting. So the green line is just annualized over 6 months. And if you look at that, that's still going up, because the last 6 months has been a little bit higher, right? And then the darker blue is just the year over year, which is basically replicates the chart that we just had. So you can see that has been just a kind of almost like a bell curve. Interesting if you look back before 2020, they were kind of struggling actually to keep inflation up high enough.
Yeah.
And so that is one of the things that they're being careful with here. They don't want to get too crazy on this downward motion of lowering rates because they really don't like that either.
Yeah, they want to kind of glide into that 2%. They
Yeah,
don't want to
right.
really
Yeah.
nosedive into it.
And if you look at the light blue, the annualized rate, just looking at 3 month time periods, at the end of last year, we were actually annualizing below 2%. And that's when the market started to take off, too, because the Fed started to probably worry that they might end up with inflation being too low. And they started to talk more positively to get the market to kind of keep inflation from
Yeah,
falling.
and the market was pricing in 6 cuts at that point.
Yeah, that's right.
It was very
Exactly.
positive time frame.
Exactly. Yeah, and then that's when the market, we had almost a 9% November, right, on the upside. So, that, of course, the yellow means the yellow line's the 2% target. So anyway, this is an important component for the market. Here we are in the middle of this negative week with all these things going on, and today we're up because of this PCE report. You can tell it has some importance for the market. It's still something to watch for. Hopefully we can stop talking about inflation someday because we didn't used to talk about it
Mm.
really because it wasn't a component of really what was going on. The Fed funds rate didn't change that much, prior to 2020 really. Some, they were going up a little in 2018, back down in 2019. It
But
makes
it
a
is more
difference.
worried about economic growth and
Yes.
actual, employment. We weren't talking about inflation.
Well, honestly, we haven't had that kind of inflation since the 70s and very early 80s. And so the most common conversation that somebody like us would have would be about a recession because we've had a bunch of those
Yeah.
since then, and some really big ones like 2008 and what have you too. So, that was the conversation all the time was, are we heading for a recession? Are we heading for a recession? And that is what caused the Wall Street to completely miss out on the 2022, fact that we didn't have a recession because it was just so different. And of course, the pandemic changed the dynamic,
Hmm.
and then the money that came out from the pandemic. So, hopefully by this time next year, we're just talking about whether we're going to have a recession or not, because that was a lot more fun, honestly. Uh, if there can be fun there, because inflation is really tough. It affects every single person. Recessions are more hit and miss as to whether it's affecting you or not. It depends on your job and type of industry that you're in and where that recession might be. But everybody's costs have gone up, and so that's a tough one. Okay, so that's our summary for the week. I really thank everybody for joining the summary. I look forward to doing it again next week, and we'll.